In a single high-frequency trading session, hundreds of billions of dollars in paper wealth can vaporize, not because corporate earnings failed, but because a currency thousands of miles away shifted by a fraction of a percent. On institutional trading desks in London and New York, automated systems begin auto-liquidating positions across global tech equities, emerging market debt, and physical commodities. The catalyst is not a sovereign default or a sudden credit downgrade. It is the rapid tightening of an invisible line of credit anchored entirely in Tokyo. For over 2 decades, the Bank of Japan maintained benchmark interest rates at or below zero to combat lingering domestic deflation. This extreme monetary policy created an unprecedented anomaly in modern finance, a virtually unlimited supply of cheap capital. International investment banks and hedge funds quickly realized they could borrow trillions of yen at near zero interest, convert those yen into United States dollars or euros, and invest in higher-yielding sovereign bonds, corporate debt, or risk assets across global markets. This massive capital flow is widely known as the yen carry trade, but labeling it a simple speculative trading strategy fundamentally mischaracterizes its actual function within the global financial architecture. It is not merely a tactical maneuver used by opportunistic traders seeking incremental yield. It operates as the foundational liquidity engine powering the modern international shadow banking system, driving credit creation and artificially inflating asset prices far beyond Japanese borders. The mechanical foundation of this trade relies on the persistent interest rate differential between the Bank of Japan and major foreign central banks. When the Federal Reserve or European Central Bank raises benchmark rates while Japanese rates remain anchored at zero, the resulting yield gap creates a massive profit opportunity. Institutional investors exploit this spread while using the underlying foreign assets as collateral to secure further leverage through cross-border rehypothecation networks. Inside corporate treasuries and global asset management firms, balance sheets are systematically optimized around this ongoing yield differential. Executing capital arbitrage on this immense scale requires continuous currency conversion. Institutional participants continuously sell their borrowed yen on foreign exchange spot markets to purchase higher-yielding foreign currency assets. This relentless selling pressure depresses the market value of the yen, creating a self-reinforcing loop that keeps global borrowing costs unnaturally low. Cross-currency basis swaps serve as the essential plumbing for these massive international capital transfers. Major global prime brokerages facilitate these multi-billion-dollar transactions off-balance sheet, allowing institutional clients to exchange foreign currencies for yen at minimal funding costs. Because these swap agreements are buried deep within complex derivative portfolios, the true aggregate scale of global yen-denominated leverage remains largely invisible to sovereign regulators and public exchanges alike. The Bank of Japan essentially acted as an unwitting liquidity spigot for the entire global banking system. Through continuous balance sheet expansion and prolonged yield curve control, the central bank absorbed massive amounts of domestic government debt while exporting low-cost funding worldwide. As Japanese domestic institutional investors sought returns outside their stagnant local economy, sovereign wealth funds and multinational commercial banks rushed to join the lucrative yen funding arbitrage. As long as Japanese interest rates remained suppressed and exchange rates exhibited low volatility, the system functioned like a high-yield financial machine. Wealth managers and private equity consortia leveraged low-cost yen loans to fund corporate buyouts, commercial real estate developments, and large-scale infrastructure projects across multiple continents. This steady flow of cheap currency acted as a lubricant, maintaining high transaction volumes and compressing credit spreads across disparate global asset classes. However, this structural dependence on continuous capital arbitrage introduces profound vulnerability into the global financial architecture. The entire mechanism relies on 2 critical assumptions: that the interest rate differential between central banks will remain wide, and that currency exchange rates will remain relatively stable. If either variable shifts rapidly, the delicate mathematical equilibrium supporting trillions of dollars in leveraged financial assets breaks down with alarming speed. When the Bank of Japan eventually signals a transition toward monetary tightening, even by a modest margin of 25 basis points, the yield differential immediately compresses. Simultaneously, expectations of higher domestic returns spark an influx of capital back into Japanese financial markets, triggering a swift appreciation of the yen. For international institutions holding vast portfolios funded by yen liabilities, this sudden currency rise represents an immediate severe expansion of debt obligations. As the yen strengthens against foreign currencies, the carry trade rapidly transforms from an efficient profit center into an accelerating drain on balance sheet capital. A 5% surge in the value of the yen can completely obliterate years of accumulated interest rate profits. Institutional risk management engines immediately trigger mandatory deleveraging protocol alerts. To satisfy expanding margin calls and prevent forced liquidation by prime brokers, fund managers must raise fast capital. The resulting liquidation cascade strikes major global exchanges with indiscriminate force. Institutional traders do not begin by selling their weakest or least profitable holdings. They sell their most liquid assets first. High-flying technology stocks, liquid sovereign benchmark bonds, and exchange-traded commodities are dumped into the market to generate emergency cash. This selling spree is not driven by deteriorating corporate earnings, but by the urgent requirement to buy back yen and settle debt. This urgent repurchasing of yen fuels a violent self-reinforcing feedback loop across global foreign exchange markets. As billions of dollars in buy orders for yen flood spot and derivative trading desks, the Japanese currency surges even higher in value. This accelerated exchange rate move triggers successive rounds of automated stop-loss orders from quantitative algorithms, spreading liquidations throughout international clearinghouses and forcing asset prices downward worldwide. During a severe trade unwind, market liquidity evaporates almost instantaneously across short-term bank funding channels. Interbank repo markets freeze up as institutional lenders refuse to accept volatile collateral or unhedged foreign exchange exposures. Prime brokerages respond by raising margin requirements across all asset categories, forcing secondary market participants into distressed asset sales and turning a localized currency shift into a broader liquidity crunch. Historical financial crises clearly demonstrate the destructive reach of this liquidity mechanism. During the late 1990s and again throughout the 2008 global financial meltdown, sudden contractions in yen carry trade positions severely amplified market panics. Assets that were previously viewed as completely uncorrelated plummeted simultaneously simply because they shared a common funding source: cheap yen leverage that was suddenly called home by risk-averse institutional lenders. The fundamental paradox of the carry trade lies in its structural temporal asymmetry. The buildup of global leverage occurs slowly and quietly over many years, pushing international asset prices higher in a predictable, low volatility environment. Conversely, the unwinding of that same leverage unfolds in a compressed window of days or hours, characterized by extreme market volatility, severe liquidity traps, and violent price dislocations across global exchanges. Monetary policymakers face an agonizing systemic dilemma when trying to manage this structural vulnerability. If the Bank of Japan maintains artificial interest rate suppressed levels to protect international markets from disruption, domestic inflation erodes purchasing power and distorts local capital allocation. Yet if the central bank moves to normalize interest rates, it risks triggering a chaotic unwinding that destabilizes major financial institutions across the globe. The cross-border structure of these capital flows further complicates effective regulatory oversight and systemic risk monitoring. Because yen borrowings are routinely routed through offshore financial centers and complex shadow banking entities, no single national regulatory authority holds a complete overview of total outstanding yen leverage. Financial authorities in Western nations remain inherently vulnerable to monetary policy decisions made in Tokyo, entirely outside their regulatory jurisdiction. Modern financial engineering has woven yen funding deep into the foundation of complex credit products and private capital markets. Private equity funds and private credit lenders have aggressively utilized low-cost currency borrowings to boost reported internal rates of return on buyout deals. This widespread practice effectively hides underlying investment risks behind currency arbitrage, leaving private portfolios highly susceptible to sudden spikes in global short-term borrowing costs. When market volatility spikes unexpectedly, the real consequences of this hidden leverage reverberate through real-world corporate and public balance sheets. Multinational corporations that issued yen-denominated debt to take advantage of low interest rates see their debt servicing costs surge in local currency terms. Municipalities and public institutions that entered into complex cross-currency swap agreements face sudden collateral demands, draining public reserves to cover private market adjustments. The yen carry trade reveals that global financial liquidity is not a static reservoir of cash, but a highly dynamic, precarious network of leveraged interbank obligations. International capital does not move around the globe solely based on regional economic growth or corporate innovation. It flows toward systemic interest rate differentials, driven by automated institutional strategies designed to extract basis point spreads from central bank policy divergence. Ultimately, the yen carry trade stands as the crucial, invisible gear within the global financial architecture, pumping essential liquidity into international markets during stable conditions and aggressively draining it away during periods of stress. Recognizing this structural reality is vital for understanding how subtle monetary adjustments in Tokyo can send shockwaves through exchanges in London, New York, and beyond, proving that modern systemic leverage knows no borders.